Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Greg Allen. Greg established Allen House Metals in Florida in 2017. He has steadily developed the company into a full-service precious metals firm. Allen House Metals specializes in the purchase, the sale, and the storage of physical gold, silver, platinum, palladium. As a registered dealer of Dillon Gage, an authorized purchaser for the United States Mint and many other government mints around the world. Prior to founding Allen House Metals, Greg played professional hockey for 4 years. After playing his career, he worked in hockey development for Toronto Maple Leafs and Hockey Canada. So, Greg, I'm looking forward to hearing a little bit more about your background, but also just really excited to dive into precious metals with you. Welcome to The Wealth Flow.
Awesome. Yeah, thanks for having me on, Keith. And I appreciate the introduction as well. I'm really excited to, delve a little bit more into precious metals. And, as you know from my background, I'm happy to talk about hockey whenever anyone gives me the chance.
Absolutely. Absolutely. Well, let's maybe do a little bit of that. And just, I like to find out, where you grew up and just, what eventually led you to precious metals. But sounds like there was, a professional hockey career along the way. So I'd love to hear about that as well.
Yeah, 100%. So, growing up like a lot of kids in Canada, where I was originally from, in Toronto, the dream was always to be a professional hockey player. And, hockey was the main focus, not only for me, my wife as well. My wife ended up playing professional women's hockey and she worked for the Maple Leafs with me as well. And, for us, we really saw that as being our whole lifestyle. And it wasn't until, 2013, 2014, where I started having, multiple surgeries in the off season, knee issues, and all these types of things, where I started saying, hey, maybe we need to look elsewhere and kind of see if we have a more sustainable plan, at least for my body. I couldn't keep up with it anymore, right? And so I think for us at that time, we kind of had the decision of, we could work in hockey development and stay there, or for us, a big thing, and as you mentioned, we started the company down here in Florida in 2017. A big thing that we were looking at around that time was, the election, the overall policy, and everything that was happening down here in 2016. And, a big part of our decision to move down here was to chase that, American dream, so to speak. And for us, the weather also was certainly a big hook to getting us down here. And I know we wouldn't trade the humidity for snow in the winter, that's for sure.
Right, exactly. Yeah, it's funny. We were talking a little bit before the show on that side of things. So yeah, well, why don't we dive into precious metals, Greg? I mean, typically you founded the Was there any exposure to precious metals before 2017? And if so, I guess let us know how did you decide to, start Allen House Metals?
Yeah, of course. So, for me, my first exposure to it was actually when I was in college. I was very lucky to go to the University of Toronto, which is the top-rated school in Canada. And when I was there, I ran into an individual by the name of Robert Bothwell. And for anyone listening, if you do a quick Google of Robert Bothwell, you'll see he's considered the world's foremost expert on Canadian-US relations. He is the founder of the International Relations Program and Public Policy Program at the University of Toronto. And early on, I had a lot of exposure to financial education from my family as a young individual. And I had the opportunity at that time to work in the precious metals industry. And so what I was fortunate to do was I was able to direct my education specifically with my undergraduate and my senior thesis towards, a master's in public policy on economic independence through exchange rates. And really what I dived down deep into was how the end of the gold standard in 1933 and then the end of Bretton Woods and the gold exchange system in 1971 impacted our overall economic structure, not just in Canada, not just in the United States, but worldwide, right? Because we're really shifting from a system where we have our currency backed by a physical asset to a situation where we give the Federal Open Markets Committee the freedom to manipulate things like interest rates, to change things like unemployment, change things like overall investment appeal, overall dollar value. And so for me, that was fantastic because the research and education under the supervision of Robert Bothwell allowed me to really jumpstart our business in the precious metals industry. And further from that, it was also huge into us launching our financial literacy program, which is our financial education program and how we help people learn about, why to invest in precious metals and really what it does for your portfolio, right?
Yeah. Why don't we maybe talk a little bit about that part of it? Just why should somebody consider and you could start with the economic side of it as well, about how now we're no longer on the gold standard and, some of the potential issues that is causing and will continue to cause. I guess if you can give us kind of your background
of course.
On that.
So, I mean, if we go back to the start of it, I think the big misnomer that we need to get over first is most people believe we were on a gold standard system until 1971, which is untrue. The gold standard ended in 1933. What followed from that was a gold exchange system. It was called Bretton Woods, okay? And Bretton Woods, what it did is it pegged gold at a set value, okay? From the years 1933 to 1971, gold was valued between $32 and eventually near the end in 1971, they raised it to $38. And what that meant was not that the currency was necessarily backed by gold, but it meant that you could exchange your US currency at a set value. Didn't matter if you were in the United States or anywhere else around the world. Now, what Bretton Woods did was it set stability in terms of the value of the dollar, as well as with trading. What eventually led to the demise of that in 1971, and it's something that we don't look at a lot in the United States, but around the world, it's referred to as the Nixon Shoku, or rather the Nixon shocks. The reason we get the term Shoku is because the catalyst for ending the Bretton Woods gold exchange system was the manipulation of currency by Japan and China at the time and how that affected trade deals. And so eventually what led to its demise was the fact that there were more US dollars in circulation than gold held in the reserve. And so the US government was in a situation when they were looking at the reserves where if everyone turned in their US dollars at one time, there was not enough gold to exchange for those paper bills. And the additional factor that they looked at is we had these countries over in Asia that were intentionally manipulating their currencies to achieve more favorable trade deals. And so at the end of it, Nixon said, in America, we're the largest economy in the world, and we're constantly getting beat down here and taking the short end of the stick on these trade deals, and we're not able to do the same thing because we're playing fair, right? We have our currency backed by this physical asset. And so ultimately the decision was made that in order to get our fair end of the agreement in trade deals, it would be better to abandon this Bretton Woods gold exchange system and move to a more free and open system in which we could manipulate our exchange rates and thereby change the value of our dollar, help out unemployment, and other factors like this. Now, if you look at the ultimate effect this had, we look at the stagflation crisis of the 70s, right? We're looking at having, gold go from in the mid 30s up to almost $900 in a period of 9 years. We had silver move from just pennies to being worth over $30 for all but a day in just 9 years. And so what ultimately followed this is we had a period of, like I said, stagflation where we have hyperinflation, but at the same time, we have lingering unemployment rates that were completely dissatisfactory to everyone. And I think it's important to reflect and look back into this period because I don't think it's too dissimilar from, the situation we're looking at in today's economy.
Yeah, for sure. Yeah, and even with interest rates coming down this past week, the question becomes, what's going to happen next? We may get some temporary relief, but is it going to just be temporary, and then we have a recession? So
yeah,
we'll see.
I think one of the big things that we have to look at, and I really always say to people in precious metals, especially when you're first getting involved in the precious metals industry, if you read articles on it, a lot of people overcomplicate it and make it seem like it's, you have to be a savant to be able to get in and get out at the right time. Ultimately, the number one thing to focus on when you're looking at precious metals is the US dollar, right? Precious metals have an gold and silver specifically. They trade in tandem and they share an inverse relationship to the US dollar. And so what that means is as the US dollar loses value, they gain value. If the US dollar gains value, they lose value, right? And so really the biggest thing that we look at when we're looking at making precious metals investments is the forward guidance from the Fed and how that monetary policy will affect the dollar. And so I think probably the most important thing we can do is specifically over the last 25 years or so since, 2000, is look at how those changes in monetary policy and changes with rate hikes and rate cuts and those cycles have affected gold, silver, and the dollar specifically.
Yeah, for sure. And when you're mentioning precious metals, we're referring to not just gold, as we kind of mentioned it as we began this, but can you maybe break down the various precious metals and their part as far as why you would want to own various?
For sure. So, really what we're working with is gold, silver, platinum, and palladium. Gold and silver are the most widely, recognized and invested in as far as precious metals go. Gold at the end of the day is the ultimate crisis commodity, right? Gold is something that's held by central banks, and currently it's being purchased at record rates. China this year alone has bought more gold than any of the central banks combined. But if we look at compared to just 10 years ago, central banks across the world have purchased more gold this year than they have, more gold this year in a quarter than they previously would have in a full 12-month period. And so when we look at gold, gold's always the first mover out of the precious metals. And the reason is when you look at economic crises, or you're looking at a safety play, the first thing the big institutions do, whether we're talking about a bank like JP Morgan Chase, whether we're talking about a central bank, whether we're talking about a hedge fund, the first thing they do is move into gold. So that's why it's the first mover. Now, silver, as a runoff of that, it trades in tandem with gold. What silver has that gold doesn't have is that silver is the second most useful commodity in the world right now. Okay? It's used in every electronic you can think of. It's used in anything that they use for green energy, solar panels, this type of thing. You look at Elon Musk, he bought multiple silver mines this year for things like Tesla, because Tesla can't get enough silver. And so silver will follow gold and tends to outrun gold in the long term. But typically it moves after gold, because what happens is the big players move into gold first. And after that happens, you have the industrial demand as well as investor demand that kicks into silver. And so really the appeal to silver is that when you have a booming economy, silver performs extremely strongly, because that's when you have all the big industrial players purchasing silver, right? And it works as well in a downturn, because precious metals typically soar in value in times of uncertainty and economic turmoil, while other things like paper investments and equities typically plunge. Now, when we look at platinum and palladium, and I'm sure a lot of people listening to this, if you haven't had exposure to precious metals before, these are a much lesser known metal, and much lesser, there's a lot less volume in trading. And in fact, palladium trading was closed for over 12 months due to the Russia-Ukraine war, because the majority of our palladium comes from that region. And so when we look at platinum and palladium, one thing to keep in mind is they're less so invested in, because the markets tend to be a little more manipulated, in the sense platinum and palladium, the main demand for them, aside from jewelry and investment, is for catalytic converters. And so what automakers will do is they'll use one of them until the price bumps up. They'll switch to the other and they'll buy that at a cheaper price. And then the opposite thing happens, right? And so they're fantastic things to invest in terms of platinum and palladium. If you think of the rarity of it, if you can believe this, all of the platinum ever mined would fit into a large suburban house, which is a crazy thought to think, right? That's an extremely rare commodity. But it doesn't have the volume or stability per se that you would get in gold and silver.
Okay. So silver, platinum, palladium, they all have some type of utility along with them. And if you were to look at a graph, you were saying that, say, gold, for instance, and silver tend to trade in tandem with one another. But
they do, yeah.
Yeah, but if the economy starts to boom, if the economy is booming and the dollar is stronger, does silver still have a tendency to trade higher?
So that's a great question. And the answer is yes. And the reason is, remember how I said earlier, the dollar's the most important factor, right?
Right.
So if we start to see a bump in the value of the dollar, right, you might see a temporary downtick in gold or silver. But because of this industrial demand and the volume, silver tends to be more resilient in those times. And while you might not see 30% gain in a year if we have, the dollar moving up and the economy's booming, you will still see a larger gain than gold. And so ultimately, I think the best tool to use, if you make the decision to get involved in precious metals and you're saying to yourself, well, hey, I don't know how I should allocate this. I don't know whether silver or gold is a play. The best thing you can use is something called the gold to silver ratio. Okay. It's really simple. This is a tool that's been used in precious metals for over 120 years. Okay. And all you have to do to get that ratio is divide the price of gold by the price of silver. And it'll tell you how many ounces of silver you can buy for every ounce of gold. Now, if we look at this over 120 years, the average gold to silver ratio in the 20th century was 40-1, meaning on average, you could buy 40 ounces of silver for every ounce of gold. Now, in the 21st century, it's stretched a little wider. We're looking more at an average of about 50-1. Okay. Now, right now, if we look at the gold to silver ratio, the markets are, we're recording this on a Saturday, the markets are closed. But if we pull up where the close was on Friday at 5 p.m., the price of gold currently, in terms of melt value, is $2,622 an ounce. The price of silver is $31.24. That gives us a gold to silver ratio of 84.18 to 1. Okay. Now, the reason this is significant is if we look back at the history in terms of gold to silver ratio, you can count on your hands how many times this ratio has been wider than 80-1. It's not very often. It's been times like when the pandemic was declared its sword, when we had the Gulf War and the oil crisis in the 90s, and other major world events. But what we know is if the ratio is wider than 80-1, silver typically outperforms gold 4.5-1 on a percentage basis. So what it tells us is we know anytime that ratio is wider than 80-1, silver's the buy, it's undervalued, and it's going to outrun gold. As that ratio closes down closer to that 50-1 range, it shows you that gold's actually the undervalued asset, and that is the buy. And so it's a really easy tool that and even a novice investor can use to say, hey, if I'm going to buy gold or silver, what's the better buy, right?
Yeah. Okay. That's very interesting. Maybe can you talk a little bit also about how one goes about buying this? Are we talking about physical gold that they're going to store? Are they? Do you offer storage options? What does that look like? And what would you recommend?
For sure. So we only deal with the physical product. And as you said in the intro, I am a registered dealer with a company called Dillon Gage. Okay, they're the authorized purchaser for the United States Mint, the Royal Canadian Mint, and virtually every government mint around the world. Okay, they import about $1.5 billion of product every single month. They don't deal with the retail investor. They have a select group of dealers like myself, as well as banks that they distribute to at an institutional level. And so when we're looking at precious metals, if we were talking just 5 years ago, right before COVID, a lot of people would ask the question, well, hey, why wouldn't I just buy an ETF like GLD or SLV instead of buying the physical? And I think really the big thing that's flipped is because of the supply and demand crunch since the pandemic in gold and silver, those ETFs changed their prospectuses. So they no longer have to or do back those funds with purchases of physical gold and silver. It used to be a requirement. So if you look at their prospectuses, it was page 7, I believe, where that was changed. The other thing that they did is not only did they stop buying it, but when they changed their prospectuses, they started selling the physical asset to take profit on. And so what happens is if they're no longer buying it and they've sold off their holdings, what really ends up happening is those funds are moving up and down with volume, not necessarily with the precious metals market, right? And so they're not tracking as closely to the physical asset anymore. The other thing is in terms of liquidity, right? Liquidity is always a concern for any investor. And so I think a lot of the reason people used to look at ETFs and instead of physical is because you log into your brokerage account, you click sell, and you sell it, right? We work the exact same way, okay? We use Dillon Gage as a liquidity partner. We are able to buy and sell in quantities in excess of 9 figures, okay? There is no concern with liquidity here. Now, in terms of what you were asking, in terms of physical product and storage, right? We specialize in what's called investor bars, okay? When you look around at precious metals, coin dealers are a dime a dozen. And for anyone listening to this, if you learn anything from this podcast, the one thing I want to get across, never, ever, ever buy a collector coin. Do not do it. They are sold at huge premiums that investors don't find out until they go to sell. And all they're bought back for is their weight in gold or silver or platinum or palladium. Do not buy the coins. The other thing is when you're dealing in physical metals, if you do buy a coin, it will be at a higher premium than a bar. The way we have to think about it is when you look at spot price, right? Like let's take silver, for instance. Spot price for silver is actually a contract for 5,000 ounces of unsmelted ore. Okay. And so the difference between spot price and what you pay for the product is the amount of work that goes into making that physical product, right? So if you're buying a bar, obviously you're going to pay the cheapest premium because all they have to do is pour that unsmelted ore into a mold. They'll stamp it with a mint mark and a serial number because we're only dealing in bars that are from London Bullion Market approved mints, LBMA approved mints, and bars that have serial numbers and are able to be authenticated, right? We don't want raw product. And so those have the lowest premium. And because they're able to be authenticated, they retain that premium for when you go to sell them. Now, above that, if you look at a round, right, not a coin, a round is something that is not as detailed as a coin, but because it's stamped with a logo and etched on the sides with those grooves, it's more work and you pay more of a premium because of it. Now, when we get down to coins, like everyone knows what an American Eagle is or a Canadian maple leaf. Those are very popular coins. These things are actually laser etched with authentication measures that you can only see through a loop. And that additional detail is fantastic for security, but it does mean you're going to pay more of a significant premium. And so just to take it back to my statement of please never buy a collector coin, I will give you guys an example of why I say what I say. I would say a large portion of our business now comes from IRA custodians who reach out to us with clients who have bought a collector coin. Years later, they're going to sell it and they get offered, the market's moved up by double and they get offered what they paid for it. And they're like, what's going on? And so for instance, I do a lot of work with Equity Trust out of Ohio, right? One of the largest alternative asset custodians in the country, over $45 billion in asset under management, $5 billion in metals alone. Their commodities managers informed us that coin dealers there on collector coins charge on average between 70 and 130% premiums. And that is why I say, don't buy them. What you're looking for is the product that has the thinnest spread between the bid and the ask. And that is an investor bar, right? These are kilo and 100-ounce bars of silver. They are kilo and 10-ounce bars of gold and platinum. And we do have every product under the sun. If you want to buy an Eagle, we have thousands of Eagles. But those are the products that are going to do you best when you're investing in them. Now, I know this is a long-winded answer, Keith, but I want to get to the storage side and the transaction side of what you were asking. So Dillon Gage, being the purchaser for the mint, they have a wholly owned subsidiary. It's called IDS, International Depository Services. Our main locations in the country for those storage facilities are in Dallas, Texas, and in Delaware. Okay. Now, the advantage to using these depositories is we open these accounts in-house, but they are completely outside the financial system. There is no reporting, no 1099s. The only people that know what's in that facility is you, ourselves, and the facility themselves. No one else. And that gives a lot of freedom. For instance, one big thing, I know a lot of your listeners are involved in real estate deals, right? One big thing a lot of people don't consider with precious metals is they're guaranteed to hold their intrinsic value. They rise in value with the cost of living, but they have no credit or issuer risk. So for instance, this past week, I had multiple clients that are storing precious metals in IDS that's non-reporting, And they're able to take their statements from that and go to the bank and secure a loan on real estate based off their precious metals holdings. And this is a fantastic avenue for a lot of people because you're able to have something that you're not worried about someone coming to steal from your house. But at the same time, you know, you're not having it reported to the IRS and every Tom, Dick, or Harry every 2 seconds type of thing. And you're able to leverage it to be able to invest in things like real estate.
And what, from a cost standpoint on the storage, you know, how much are you spending on actual? I'm sure it depends on how much you obviously have stored there, but does it still make economic sense to be able to store it? Seems like it would be safer than just storing it at the house for sure.
100%. And I do want to say we do offer physical delivery as well. We ship anywhere in the United States. FedEx, 48-hour, fully insured, direct to your door. It's the quickest in the industry. But in terms of storage cost, anyone, for instance, that would want to buy from this podcast, I would say the same too that we say to people from IRA custodians. We typically make sure storage is free for at least the first 3 years for you. Following that, if you were to open a storage account through us, it's a flat fee. It's $15 a month. That's it. So that doesn't matter whether you have $100 in gold or $100 million in gold. It's $180 a year or $15 a month. But as I said, we make sure it's free for minimum the first 3 years for our clients. The other thing I do want to emphasize is, as you said, storage can be extremely expensive. And so if you look at the industry standard for under $250,000 stored in the vault is 65 basis points. So that means for every $100,000 in product, you're paying $650 a year to store. And that's when it really starts eating into your return, right? I know a lot of people here actually could pay more than that to manage their investment accounts. If you have a managed account, for instance, with an organization like Fisher, or if you have a checkbook IRA at a custodian, they might charge you up to $1,800 to manage it. But we try to keep the fees as low as possible. So typically for us, once you purchase, you have no fees at all other than your account maintenance fees at a custodian. Or if you're not doing it through an IRA, you have no fees for the first 3 years.
Oh, that's great. Yeah, that's pretty amazing. Well, and as far as purchasing, though, if we're looking at bars, you're purchasing full bars. So what is there an ability to do any kind of a fraction of that? Or if you do that, are you having to go into the buttons and the various other options?
So a great question. We don't have a minimum requirement like a lot of other dealers would, right? There's a lot of dealers out there that won't even talk to you unless you invest $100,000. For us, we even have a subscription program where we have people sign up for as little as $50 a month, and they're able to get a bar for $50 a month every single month. And so really what it comes down to is you can purchase in smaller quantities, but you have to think the bigger quantity you purchase in, the better price you're going to get typically, right? So a 100-ounce bar or a kilo bar is going, not by a lot, but you're probably going to have 1% cheaper than a 1 ounce or a 1 gram bar. But what I would say is we're able to cater to everyone from, a $50 a month subscription in silver all the way up to multi-million-dollar institutional transactions.
Okay. Yeah, I guess when I was thinking bars, I was just thinking this like huge bar, but it sounds like, they're various sizes of them.
Well, one thing, and I do encourage people to take delivery at least of some of it, because when you get, a bar in your hand, it's an interesting experience because you don't realize how, I guess for lack of a better word, how nifty it is to have, an asset like that in your hand. And so a lot of people think of those gold bars you see in the movies, of like Italian Job. And when they're buying a gold kilo, they think they're getting this massive bar. Those bars are the same bars that are stored at Fort Knox, right? Those are 400-ounce gold bars. So if you look at the price of gold right now, If you were to buy a 400-ounce gold bar like you see in the movies, it's over $1 million.
Oh, wow.
So, I have a lot of clients who on a quarterly basis will top up buying gold kilos. And to give you an idea, kilo bar of gold, which we're looking in the $80,000 range for, is about the width of a deck of cards, and it's about 2 inches longer. So gold is a very dense metal. So a lot of people get them, they're like, I thought it would be bigger, but they're certainly heavy. I'll tell you that.
Yeah. Yeah, that's interesting. I had another gentleman on and just kind of showing like how much these were like more like buttons, I guess, but they were, it was like in a little circular deal.
Yeah.
But just, it was incredible the difference between that and, the weight of silver, for instance. And that was almost like his tray to even get remotely close. So
100%. And I don't have any on me this very second while I'm recording from my home office. But just to give you an idea while we're here, that is a gold kilo in my hand. So just like a deck of cards, a little bit longer. Beautiful bar, serial number on the front. This one comes from the Royal Canadian Mint. It's the best gold kilo you can get. But you can see it's definitely not as big as the one you see in the movies, right?
Right, exactly. That's awesome. Yeah, it would be neat to certainly to be able to actually take possession of some of it. It's just a matter of storage and that kind of thing. But very neat. And so it sounds like too, you have options. You mentioned $50 a month, but there are options if you're like, hey, this is definitely something I want to include in my portfolio. And you don't want to necessarily invest in it all at once. You have the ability to kind of subscribe to a specific amount.
And it's like anything, right? When you're investing, I think, your comfort level and your knowledge on that specific industry is paramount, right? And so we understand as well, no one's going to run off the street having never bought gold before and say, hey, I'd like to throw 50% of my portfolio in this, right? And so I think we're advocates as well of that whole, crawl, walk, run type strategy where you need to get familiar and understand that we can build this trusting relationship and do business over time, right? No one's here to say we have to build Rome in a day, so to speak.
Right. Yeah, for sure. And you mentioned being able to borrow against it, which I thought was, and this may vary obviously from lender to lender, but are most banks going to typically give dollar for dollar on that, or a percentage of it, or?
So what we do for clients who are borrowing against it is we'll put together an account statement and what's called a fair market valuation. And so in that fair market valuation, you can literally take that to the bank in the sense, this is what it's worth. It's got your account number on it, the storage facility and everything. And my 2 clients that did it this week, one of them was buying an additional investment property for short-term rentals. The other was buying a second home for him and his wife. And so they were able to get dollar for dollar value on those statements for those loans. And for them, it's a fantastic way to have money outside the financial system that you're still able to leverage for personal gain, right?
Yeah, for sure. Let's maybe talk a little bit about some of the advantages, and we've talked a little bit about it, but Greg, if you could maybe give your take. Obviously, kind of some crazy times. We happen to be in an election year, and there's a lot of instability out there right now. Again, rates have come down a little bit, but it just if you look at the economic outlook for the world right now, we're still trying to compete to be, the number one currency that's used throughout the world, and but there's some challenges coming up with that as well. And so maybe where does gold and precious metals kind of play into all that?
So, and that's a fantastic question. I think one thing just to even get to that I would like to segue to, just to give people a little bit of an understanding is when we look at monetary policy in this millennium, right? If we look at the last, really, we've had 3 to 4 major hike and cutting cycles, right? From 2000 till now. Well, prior to 2020, typically we had interest rates that were hovering between 0 and 2.5%. Okay. And as we had rates sitting between 0 and 2.5%, the dollar on the index typically fluctuated between a rating of 72 and 102. Okay. Now, what's happened since COVID that's changed all this, and we have to keep this in mind, is the Fed printed 70% of all US dollars ever put in circulation in a period of 18 months. Okay. Now, the typical thought would be, okay, they printed that much money, the dollar's just going to tank in value immediately. What kept the dollar stable is the Fed started hiking rates, right? And with every bump in the rate, we got a bump in the value of the dollar on the index, okay? Don't get this confused with our purchasing power, because we all know we lost from COVID to now, we've lost 31% of our purchasing power to inflation. We're just talking about the dollar on the index versus the basket of currencies it's compared to. And so because the Fed printed all this money, we saw ourselves going, as I'm sure we all remember, to an inflation rating at 9.1% at its peak, right? And so with inflation swinging like this, instead of having to go to 2.5%, the Fed went from 0 to 5.5%. So instead of the dollar peaking at 102, it peaked at 115. Okay. And the reason I reference this is, as we all know, this past week, we entered into the start of this interest rate cutting cycle. Make no mistake, the first 50 basis point cut, while it's nice that we got, a larger cut than necessarily expected than the 25 basis point cut, this is the first of many over the next 18 months, right? And so the dollar just this year, since the Fed stopped hiking rates and now began cutting rates, has fallen from 115 all the way down to 101. Okay. Now, if we look at what's happened to the dollar in past interest rate cutting cycles, on average, the dollar has fallen from that level of 101 to 102 down to 72 on the index. And economists and analysts alike predict that this time will be no different, right? And so now with the breakdown of the dollar, we're going to see a broader commodity market boom. We're not just talking metals, we're talking commodities across the board, and this will benefit metals, right? But when we look at the performance of precious metals in an interest rate cutting cycle, because that's really the most important thing we should look at, because that's what we're going into for the next 18 months here. Silver, for instance, the average return on silver in the last 4 interest rate cutting cycles is 413%. Now, don't get me confused. I'm not sitting here for a second telling anybody that silver is going to go from $31 to $120 in the next 18 months. Simply put, we know that an interest rate cutting cycle is extremely bullish for precious metals, and so it's a great buying opportunity. Now, if we look at how this is going to affect the broader economy, right? A big thing with falling interest rates is we have falling yields as well. And so precious metals not only become a lot more attractive because of the fact that the cost of holding them goes down, right? You have other high yielding products that are no longer yielding what they used to. But additionally, if we look at a tool, for instance, used by a lot of analysts, we can look at, for instance, the S&P Commodity Index versus the S&P 500 over the last 3 cutting cycles. Right now, the ratio in terms of the cost of owning precious metals versus owning, equities is at an all-time low. The ratio is below a reading of 1. And if we compare this to just 2008 in the financial crisis, that ratio peaked at 10 to 1, meaning it was 10 times more expensive to hold precious metals, losing out on those higher yields. So where I'm going with this is falling yields, falling rates, the dollar's losing value. Precious metals have a lot less opportunity cost, right?
Yeah, that's pretty amazing. So lots and lots of opportunity there, and what do you see happening? I guess you've just kind of described what you see happening over the next. You're thinking how long do you think this rate cutting will be going on in the economy?
So one thing I always like to emphasize, whether it's with our clients or whether we're, on a podcast or a webinar, is I typically will present the facts that are put forward from the major banks and the leading analysts.
For sure. Yeah.
And allow people like myself to make their decision based on the data. And so if we look at projections right now from major banks on what's happening with gold, what's happening with silver, all the major banks across the board, we're talking JP Morgan Chase, TD Bank and TD Securities, Citigroup, Bank of America, UBS, many others, all have predictions of a move by Q1 of next year to $3,000 in gold. That's the next target for gold, right? The target in silver, and also just to emphasize, gold right now is at an all-time high, but it's currently sitting at 26.24. So basically what they're telling people is they're looking for a return in the neighborhood of 18 to 25% by Q1 next year. This is not something that you can do in precious metals every day, right? Typically, precious metals are something like watching grass grow. You put a portion of your portfolio in it. It's a value hold. And for instance, CPM Group has a 50-year study from 1968 to 2018, where the average return is about 8.3 to 8.9% a year. So returns like this in such a short time, this is maybe only the third time in the last century where it's possible, right? When we look at silver, all of those major banks as well, their immediate forecast for silver within the next few quarters is a move from $31 to $42.47. Now, one thing I do want to emphasize, because a lot of people will look at the chart and they'll say, look back to 2011 after the financial crisis, right? Gold's all-time high was $1,967, which it hit for all but a day. Silver hit $49.82 for all but a day. And so a lot of people say, well, hey, we're near, in silver we're not, but in gold we're at an all-time high. In silver we're on our way to a new all-time high. Is now the right time to buy, right? Like, is it going to fall out from under me? And I mention it because it's a huge distinction these major banks have made across the board. If you look at silver and gold in 2011, when they hit those all-time highs, when they broke through resistance, they reached those all-time highs within 10 weeks, okay? And so any market you look at across the board, healthy markets are always 2 steps forward, half a step back, right? Whenever you see a market surge straight up, usually what that means is when you have a correction, it's going to surge straight down. And so the difference in the rally we're seeing right now is this rally is being caused by a global economic shift of policy. We've now had silver steadily above the $30 trading range for well over 3 months throughout the year this year, right? And so we've built those levels of support. When we look at gold, it seems like no matter what announcements or what data comes out, they can't hammer it down below 2,500. And so the major banks are really coming out here and saying this rally is different because it's slower and more sustained. We're building higher highs and higher lows everywhere up the line. We're not just shooting up in a straight line. And so part of the benefit of that is it's not something that you have to absolutely get in before the rally or you're going to miss it, right? It's something that you can add and continue to add throughout your position and make sure that you have a decent cost average in, right?
Yeah, for sure. It's just an interesting topic altogether, and it sounds like just an amazing time to consider it as part of something in your portfolio. So, Greg, this has been really great. I'm probably going to take you up on having you back on the podcast at some point, so we can go a little longer. But this has been just really good. I want to be respectful of your time here today. how can people find out more about your company if they want to invest with you? If you want to just point everybody to where they can connect with you.
100%. So first thing I would say is connect with me directly. My direct line is 561-946-9308. My email is real simple. It's my first name, Greg at allenhousemetals.com. And we do have our website, which is allenhousemetals.com. Anybody from this podcast, if you're considering it, our job here is to educate you and allow you to make the decision that benefits you, right? And so anybody that's interested, don't hesitate to send me an email, give me a call. We're always happy to review charts and make sure we inform you on the industry. And I always say to anybody reaching out is make sure you reference this podcast with Keith and I, because anybody that reaches out from the podcast, we're going to make sure that they get a discount off their purchase and that we make sure we cover those storage fees or additional fees for those first 3 years.
Perfect. Okay, that's great. Thank you so much, Greg. This has been really good. I've got 2 more questions for you that I ask every guest. One would just be, any advice you would give somebody who's maybe just starting out in their investment journey.
Yeah, I think the most important factor that I would tell people is it's a marathon, not a sprint. And I find too often people are coaxed in by massive returns that come very quickly and they see the dollar signs popping up. At the end of the day, being consistent over time and investing steadily in your future and putting your money in places that not only hold value, but provide consistent returns are much better in the long run than purchasing necessarily a get rich quick scheme or a pump and dump, so to speak.
Yeah, for sure. No, I think that's great advice. How about a book recommendation? It doesn't necessarily have to be on precious metals, but it certainly can be. Just something you've read that's been impactful.
So I would turn people to 2 different books, same author. Ray Dalio, the founder of Bridgewater and Associates, largest hedge fund in the world. He has 2 fantastic books that will change the way you look at your portfolio no matter what you're investing in. First one is Principles of Economics and Investing. My personal favorite, though, is the Principles for the Changing World Order. And it's fantastic because in the Principles for the Changing World Order, he walks you through Bridgewater's investment model and how they were able to build it. Believe it or not, their investment model has nothing to do with charts and everything to do with global macroeconomic trends, political trends, 28 different factors. You will feel like an economic expert after reading one of them, but it's fantastic information.
Fantastic. All right. Well, great. No, those are 2 good ones. And certainly appreciate your time today and really appreciate you being on the Wealth Flow. This has been a tremendous show. So thanks, Greg.
Awesome. Thanks for having us on, Keith. And, we're really excited. We can't wait to come back whenever you'll have us.
Absolutely.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.